If you are at all interested in investing, you've probably heard of index ETFs, and there's very good reasons for this. It's extremely easy, it's extremely simple, and it's one of the most effective ways at building your wealth, especially when you're relatively new to investing. However, despite its ease, it can still be very confusing for a new investor. Why are there so many different index ETFs? What's the difference between a BlackRock ETF and a Vanguard ETF? What is the expense ratio and why is that important? And once I've found an index ETF or multiple index ETFs that I want to invest in, how should I go about investing in them? Today, we're going to break all of this down in as simple a way as possible. If you're new to the channel, welcome. My name is Brandon, and here at Wealth Potion, my goal is to explain finance, the economy, and even business building in the simplest way possible. And ideally in a fun way as well, because let's face it, finance, the economy, it can kind of be boring sometimes. But it shouldn't be, because whether you're building your wealth or if you're building a business, it really is like a giant real-life video game. So today we are going to dive into the topic of index ETF investing, and we're going to break it down in very simple and fun terms, because an index ETF is just like a fruit smoothie. Let's dive in. First, we have to cover the basics. What is an index ETF? Well, there's two parts to that term. There's the index and the ETF. First, let's talk about the ETF, because this is simpler. An ETF is an exchange-traded fund, and there can be an ETF for basically anything. There are ETFs for indexes or indices, as we'll talk about in a moment, but there's also ETFs for commodities like corn and copper and gold or Bitcoin. So an ETF really simply is a tradable fund so that when you log into your brokerage account, you can buy digital shares of an ETF instead of having to go buy physical gold or physical copper. Or in the case of an index ETF, you don't have to go out and buy individual shares of all of these different companies. An index is basically a bucket or container of stocks. The S&P 500 is an index. The NASDAQ is an index. I'm in Korea, so the KOSPI is another index. But basically, it's a bunch of stocks bundled together. And I like to use the example of the S&P 500 because it's one of the most well-known indices, and it's also convenient because it has the number 500 in it. The S&P 500 is the 500 largest publicly traded companies in the United States. And so let's say you want to invest in the S&P 500. One way you could do this is buy individual shares of all 500 companies. However, when people want to invest in the S&P 500, generally you want to have an equal weighting of all those companies. And the problem is stock prices trade at very different levels. Apple right now is trading at about $100, Nvidia is trading at about $200. Berkshire Hathaway, Warren Buffett's company, one share is trading at $780,000. So here is where the analogy of a fruit smoothie comes into play. By saying we want to invest in the S&P 500 is like saying we want to eat 500 different fruit. But because we want equal weightings of those 500 companies, we can really imagine fruits like blueberries, strawberries, and raspberries compared to watermelons and durians and mangoes, all fruits of different sizes. Of course, if you want to make a fruit smoothie with equal flavor of these different fruit, you wouldn't just use one blueberry and one watermelon. Just like if you want to invest in the S&P 500, you wouldn't buy one Apple share and one Berkshire Hathaway share. So instead of buying individual shares in all of these different companies and trying to weigh it perfectly, you can buy an index ETF that tracks the S&P 500. What the issuer of the index ETF does is they prepare all the fruit, they get all the right weightings of the small fruit and the big fruit, and they provide you with a single smoothie that you can purchase and drink at your leisure. And this is one of the huge reasons why index ETF investing is so popular and so effective, because you don't have to manage any of that rebalancing. You don't have to make any of the fruit smoothie. You literally just buy a smoothie from the store and you enjoy it. However, if you stop the video right now and you go to your brokerage app, you might get stuck where a lot of beginner investors get stuck, which is, oh my goodness, there are so many different index ETFs. Where do I even begin? Even just for the S&P 500, there are multiple different S&P 500 index ETFs. So what gives? What is going on here? The first thing we need to discuss is the issuer of these index ETFs. It's kind of like if you want to get a fruit smoothie, you could go to Jamba Juice, or you could go to Booster Juice, or you could go to Whole Foods or Erewhon or the grocery store or the local shop down the street. So let's look at an example. Here we have three S&P 500 Index ETFs. One is offered by BlackRock or iShares, one is offered by Vanguard, and one is offered by State Street. To use the fruit smoothie analogy, you can think of these as three different smoothie stores. The key difference here is that the ingredients are exactly the same. It's not like BlackRock is using higher quality strawberries than Vanguard. They are the exact same companies at the exact same proportions inside these index ETFs. And that is why if you compare the performance of these index ETFs, they are virtually identical. There are some minute differences between the two, but by far the most important one that I want you to take away from this video is what's called the expense ratio. As we discussed in our analogy, you aren't doing any of the work of having to divide up the fruit and rebalance every day so that you get the same amount of proportions as the individual companies grow and shrink in size. That work is being done by the index ETF issuer, whether that's Vanguard or BlackRock, etc. In order to do that work, they charge a fee, which is reflected in what's called an expense ratio or an MER, a management expense ratio. If we look at these three index ETFs, we can see that the iShares and Vanguard ETFs have an expense ratio of 0.03%. Whereas the State Street expense ratio is almost 0.1%, which is over 3 times as much as the other index ETFs. And I know what you might be thinking, these are still extremely small numbers, but as we've discussed in previous videos, those small percentages compound over time. The example we used in a previous video shows that a 1% fee can compound to over 10 or even 15% of your wealth when you go and retire. Again, even though it seems like a small number, generally the advice is to find the index ETF with the absolute lowest expense ratio possible. You could argue that 0.09 and 0.03 are relatively close. The big one that you want to avoid is with certain mutual funds. So as opposed to an index ETF that's kind of automated, there are often mutual funds offered by banks where they have more of a team and you can call in for support. And because they have more costs associated with their ETFs or with their funds, these expense ratios can be much higher, closer to 0.5% or even 1%, just like the example I've shared in the past. If you really want to dive into the differences between Vanguard and BlackRock and State Street, the differences are minor, but the expense ratio is the one difference you probably want to look out for. So to come back to our fruit smoothie analogy, the Jamba Juice smoothie is the exact same as the Booster Juice smoothie, which is the exact same as the Erewhon smoothie, but the Erewhon smoothie is a little bit more expensive because the employees there are paid better. So if what you really care about is the quality of your smoothie, you should really just go with the issuer that charges the lowest fee possible. All right, so we've discussed the different brands and issuers of index ETFs, but that does not address the huge world of index ETFs outside of just the S&P 500. Because as mentioned, an index ETF tracks some index, but there are so many different indices. I mean, there's the NASDAQ, there's the Dow Jones. You can find an index ETF that tracks dividend companies or emerging markets or the stock market minus the US if you want to invest in everything but the US. You can find index ETFs for practically any combination of stocks. While yes, it can be overwhelming when you see all these different options, this is ultimately where you express your view and your values into your investment portfolio. Again, I use the S&P 500 because it's simple and it applies to a lot of people that want to just invest in the overall growth of the US economy. But if you feel particularly strongly that the US economy is not going to be dominant in 10, 20, 30 years, you could invest in index ETFs that don't weigh the US as highly. Or you could invest in multiple index ETFs. Maybe you have 50% in an S&P 500 ETF, but then you put the other 50% in an emerging markets ETF. Now, important to note, I would be careful with how much you express your views through your portfolio. Just because Trump is president and tariffs are creating a lot of chaos is unlikely to change the trend of the S&P 500 over the past 100 years. It has been an incredible investment. So be careful thinking that you know better than the market. This is the whole point of passive investing in the first place. And if you do express too much of your view, especially if you're trading in and out of these index ETFs over time, then you're not really passive investing, you're more of an active investor. And that's where we need to be careful. But generally speaking, it is totally fine to create a portfolio portfolio of index ETFs based on your views. And the great thing about index ETFs is that they are inherently diversified. The S&P 500 Index ETF has 500 companies in it. So if one company absolutely crashes, you are protected from that downside because you're spread out across 500 different companies. Now, there is one last ETF I want to make quick mention of, and we will do a deeper dive video on this very, very soon, but there's also a Bitcoin ETF. If you follow Bitcoin even a little bit, you might have heard this news from a year or two ago, where the US basically finally created Bitcoin ETFs. This is slightly different than an index ETF because it's not like a portfolio of companies like the S&P 500. It's literally a single commodity or asset. The reason for a Bitcoin ETF is not because you're getting a fruit smoothie with 500 different fruit. It's because it makes Bitcoin much more accessible for the regular investor. Many Bitcoiners, myself included, would encourage people that want to invest in Bitcoin to do it the proper way and actually buy Bitcoin on a Bitcoin exchange and then move it onto a cold storage wallet, but that can be very difficult for someone that is very new to Bitcoin. And so a Bitcoin ETF is one way to invest in Bitcoin without having to go through that whole rigmarole and just by using your typical brokerage app. An additional benefit, by the way, of a Bitcoin ETF is that you can hold that ETF within a tax-free account, which we covered in this video, and that is incredibly important, especially with an asset like Bitcoin that can grow extremely fast over time. If we need to use an analogy here, this is a bit of a stretch, but I would think of a Bitcoin ETF as a turmeric smoothie. There's a single active ingredient you're looking for in a turmeric smoothie, just like a Bitcoin ETF just has Bitcoin. It's very healthy. You know, turmeric is extremely healthy for you, and Bitcoin can really supercharge your investment portfolio, but it's kind of hard to just eat turmeric or add that to your diet unless you're cooking dishes with turmeric. Just like it's very difficult to simply add Bitcoin to your investment portfolio if you don't have a cold storage wallet and you don't know the technical lingo. And turmeric is orange, just like Bitcoin. Needless to say, a Bitcoin ETF and other ETFs that focus on single commodities are different from index ETFs, where one of the main benefits of an index ETF is the diversification of holding a lot of different companies or assets. Of course, with a Bitcoin ETF, you're just getting Bitcoin, so you're not getting diversification. A Bitcoin ETF is if you believe in Bitcoin. All right, that's it for today. Hopefully that covered your questions. To really recap here, yes, there are a ton of different index ETFs. First and foremost, understand that there are different issuers, even of the same kind of index ETF, and that the differences are minimal. The main difference you want to look for is the expense ratio. And then secondly, within the world of index ETFs is where you can look at these different combinations, the different indices, express a bit of your views and a bit of your values through your investments. You can do this in such a way that still maintains the diversification that index ETFs allow, but you can mix and match index ETFs to make sure that your investment portfolio is strong and it's something that you believe in. And as we're going to cover in a video very soon, having confidence in your investment portfolio is incredibly important, because the last thing you want is for a market downturn to happen and then you to question your investments. What you want instead is for a market downturn to happen and then you to be so confident in your investments that you actually want to buy more because you're getting it at a discount. So as always, if you have any questions, if you have any comments, leave them below. If you watched this far, I really appreciate you. Like and subscribe to the channel, and I'll see you next time.